Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to CEO Sandy Chahar and CFO Suzanne Smith of Supreme, a leading UK distributor, in-licenser, and owner of FMCG products across vaping, sports, nutrition, lighting, batteries, and recently soft drinks. So welcome, guys.
Yeah,
Thank you, Paul.
Oh, big congrats on today's record FY24 results. But before we sort of dig into the details there, I suppose you could, Sandy, give us a quick sort of like overview of the demand picture out there in the field for the company's products.
Yeah, look, overall, really happy with all our categories. I believe they're performing well. Batteries record year, lighting is up from the previous year, wellness is up, vaping is well up. Everything is going super well. So overall, the demand, we've not seen any shift of demand on any of our products, whether it be disposable or whether it be vitamins or whether it be batteries. They are all performing really well.
Oh, and why is that, Sandy? Is it something to do? Obviously they're affordable type, sort of products, etc. Because there still is the drag, the tail end of the sort of cost of living crisis, and a lot of brands, sort of main big luxury brands in particular, have been struggling. But yours seems to be bucking the trend and sort of chiming with consumers.
If you think about most of the products we sell are £2 and below. A lot of our products are even below £1. So it's at that end of the market where it doesn't really matter. And you've got to remember that our products are the highest quality with a good brand, but at the lowest price. And that way we're always protected. Recession or no recession, I don't think. In fact, we'll probably do better in recessions because people will trade down to our products and our brands.
And is that the sort of the glue, the magic sort of like source of Supreme? It's the distribution, but also getting that right sort of product mix, for the consumer.
Yeah. The right price with the right product mix is key into the right retailers. Absolutely. And I think we've got that nailed on at the moment.
Yeah. Okay, good. Just if we just drill down onto sort of vaping, obviously the company's biggest division at the moment. How do you see the sort of prospects for vaping, given the sort of the new legislation coming in sort of like, I don't know, 9 months time with the ban on disposables, and a bit later in, I think it's 2026 for the tax hike?
Yeah, I think with the new general election and with potentially a new government, I think the whole vaping bill has to be done all over again. I think there's going to be some delays on some of this stuff. So we're still banking on it happening when it's going to happen, but the general consensus is that we believe there's going to be delays, and we don't know at this stage. We'll know more. However, we're starting seeing traction on not only our pods but our bigger sort of puff devices where it's a £12 retail, and these products are even post the disposable ban will become able to sell and are selling pretty well. We've started getting some good giant size orders starting to come through now. So yeah, I'm confident with the disposable ban will not have effect on us. The tax is 3 years away, and I don't believe at this stage we have anything to concern. We believe that our brand is so strong, and we believe that we can also stock up for a fair chunk of time to hold on stock and pass that slowly, that extra margin on to the retailer.
Good. Okay. Well, move now to the financial highlights, Susan. I must admit, I have to sort of tip my hat here with sales up 42% and with gross margins also increasing and a big cash pile. So can you just talk us through sort of like what's been happening?
Yeah, you've touched on the three key metrics. Sales are up, profit substantially up, and the cash that we've generated is also up. So I think fair to say a clean sweep. Yeah, we've grown sales 42%, which in a year when we haven't really acquired anything substantial is a significant result. Almost all of that growth has come organically. Now, of course, the lion's share of that growth has come from the Elf and Lost Mary distribution opportunity, but also we've reported growth across every single one of our product categories. Vaping, aside from the Elf Lost Mary point, is up 9%, wellness is up 8%, lighting's up 7%. So we've seen growth right across the board. And to add to that, as you touched on, the gross margins as a percentage of sales in every single one of our categories is also up. We've had consolidation of manufacturing within vaping. We've had price deflation from core components in wellness. We've seen a consolidation of the supply chain in lighting, and we've just benefited from economies of scale across the board. So we've worked harder and we've also worked much smarter this year. And then to add to that is the cash generation. We've generated more than £27 million from our £38 million of EBITDA, which in a year of significant organic growth, which when you're selling consumer goods like we are, means an investment into inventory and an investment into debtors, is a substantial result. Now, and what's happened is that the business required an investment into working capital to finance the expansion of Elf, but the rest of the business reacted and adapted accordingly to make room for Elf in our warehouse and also on our balance sheet. So that just shows the collaboration across kind of that shared platform that we talk about and we place so much value on. So yeah, just a clean sweep of financial metrics across the board. It's been great.
Yeah, and in terms of the gross margins, obviously you mentioned that's ticked up because the input cost inflation, or you've seen de-inflation in certain ones on the economies of scale. What's been happening at the pricing level with the ASPs, the price points?
Our selling prices, you mean?
Yes.
Nothing noteworthy. Now we saw a price deflation in wellness, as I mentioned, and where appropriate and where possible, we've passed those back on to the retailers, and that's why we've got these kind of 20-25 year relationships with some of the retailers, because there's a real transparency. But price increases and price growth isn't the driver for either our sales top line increase or even our margin expansion. It's at the manufacturing and the buying end where we've seen all of the gains.
Yeah. So you say your increase is this volume then, isn't it? Essentially, that's what you're saying.
Volume and scale. Yeah, exactly.
Yeah. Brilliant. Okay, good. Okay, well, let's move now to the sort of first impression, Sandy, of the Clearly Drinks acquisition. Obviously, we chatted, about 10 days ago or a week or so. Seems to have gone very well, obviously. But just give us your first impressions, because you've probably been up there into Sunderland.
Yeah, no, I love the business. I love the people. I think they're really good. I mean, they've got a very similar culture to Supreme. I'm going to do it culture, which I really love. So yeah, so far it's only been a week, but we've got some really incredible good ideas coming through now, and it won't be long. By the end of the year, I think I'll have another shift going. That's what my ambition is.
Good. Just further on that one, Sandy, your long-term sort of like vision for the business in terms of sort of your mix between sort of own brand and third-party brand, but also across the relevant categories. Obviously, you specialize in ambience and non-perishable goods at the moment. It's just that what is the Chadha sort of like long-term sort of like vision? Where would you love the business to be in 5 years?
Yeah. So in terms of actually where we'd love in 5 years, they have brands. One of them is called Perfectly Clear. It's the first flavored water on the market in the early 90s. It's got good brand recognition. We want to grow that, double that in the next 18 months, maybe even triple that. I really want to go for that side of the business. We're also going to look at acquiring brands that are well recognized, that have good traction and good turnover in the UK, and buy those brands and then move the manufacturing from wherever they are to Clearly. And that means that our payback is nearly half the time, right? If you think about it, if I buy a business 5 times, and I then have the manufacturing margin as well, I may reduce that 5 times down to 2.5 times. That's another plan. So growing it with a combination of our own brands that they've already got, some Supreme brands, and brands that we will buy that we will then move the manufacturing in-house, if that makes sense to you?
Yeah, and keep it within the sort of distribution chain so you get those economies of scale.
Absolutely. Yeah.
Good. Okay, Suzanne, in terms of sort of the investments going forward, obviously you generated so much cash that you could afford to pay for Clearly Drinks out of almost like pocket money as much as anything, not quite. But what's sort of like how do you see the sort of the investment sort of going forward within the business, or are you going to carry on paying, dividends and stock buybacks?
Yeah, no, you joke about paying for Clearly out of pocket money, but it was entirely from the cash that the business had generated in the previous 12 months sitting on the balance sheet. It was the best use of the cash, but we didn't have to draw on any borrowing facilities. So we reported that we were bank debt free at 31 March, and we remain that today despite the investment into Clearly. And we've continued to invest and grow our own business at the same time. We've continued on our kind of capex plan. So that in itself is is a great result for us. In terms of looking forward, M&A and financing organic growth continues to be our primary objective. We know, and our investors tell us, that the best return on our money and the best use of that capital is for us to go and buy complementary, earnings enhancing acquisitions that slot into our platform. Thereafter, if there isn't an acquisition or there isn't an opportunity, rather than it just sitting in the bank, that's when we have conversations about dividends, special dividends, or share buybacks. And the share buyback we did this year, the primary objective there was really to instill confidence, and we think it did that at the time when, you know, the kind of press coverage was you know, it's very speculative and no one really knew what was going on. That was the right thing to do. Whether we do another buyback in the future, whether we look at a dividend, TBC, but primarily the overarching objective is to refinance it back into the business and to continue to do acquisitions just like the Clearly Drinks and the other acquisitions that have gone before it.
Brilliant. Okay. And then just in terms of sort of the trading for this year, Suzanne, and how's the sort of the first 3 months gone on?
Very pleasing. Yeah, very reassuring in the core business. We started the year managing expectations at around a £35 million adjusted EBITDA result for FY25. We acquired Clearly Drinks last week. We have seen some real positive momentum in Q1, and as a result, we're now managing expectations closer to 37.5 million. So we're really confident about the expectations we have out in the market and delivering on those. Not forgetting, we're also only 1 quarter in, which at this point in the year, I'm quite cautious when we're managing expectations for the full year, that there's still 9 months to go. So let's see where we end up at the end of the year. But yeah, a really great start. Couldn't have asked for anything more so far.
Brilliant. And the next sort of update and trading, you know, I guess it's probably at the AGM, is it September or so?
Correct. Absolutely. Yeah, September.
All right, brilliant. Well, thanks very much again, guys. Massive congrats on the record results and positive outlook. So look forward in touching base in about 3 months' time.
Thank you.
Thank you.